everybody. Welcome to this meeting, open meeting of the FDIC Board. I'd like to call the meeting to order. We have several items on the summary agenda this morning. Are there any questions or comments on the summary agenda? If none, may I have a motion to approve the summary agenda? And a second?
Second.
Thank you. All in favor, please say aye. Aye. Those opposed? The motion is adopted. And we have one item on the discussion agenda this morning. It's a briefing on the semi-annual update of the DIF restoration plan. Pat Mitchell, Ashley Mihalik, and Sheikha Kapoor will present the briefing. Pat, it's all yours.
Thank you. Ashley will present. Thank you.
Good morning, Chairman Gruenberg and members of the board. I'm here today to deliver the first semi-annual update of 2023 for the restoration plan of the Deposit Insurance Fund, or DIF. For background, as of June 30th, 2020, the reserve ratio fell below the statutory minimum and stood at 1.30%, due solely to extraordinary growth in insured deposits during the first half of 2020. On September 15, 2020, the board adopted a restoration plan to restore the reserve ratio to at least 1.35% within the statutory 8-year period ending on September 30th, 2028. The plan requires staff to update analysis and projections for the Deposit Insurance Fund, or DIF, balance and reserve ratio at least semi-annually. This is the first semi-annual update for 2023. Staff recommend no changes to the plan at this time. In the second half of 2022, the reserve ratio increased by 1 basis point to 1.27%. Despite increased uncertainty in the banking industry and the recent failure of 2 large banks, staff project that the reserve ratio will reach the statutory minimum of 1.35% ahead of the statutory deadline of September 30th, 2028, though the precise timing is unknown and depends on a number of factors. The analysis and projections we are providing today are based on data reported as of December 31st, 2022, and therefore do not yet reflect the 2 basis point increase in assessment rate schedules, which became effective on January 1, 2023, or recent bank failures and the related effects on the DIF and the banking industry. Under the restoration plan, the FDIC is monitoring potential losses, deposit balance trends, and other factors that affect the reserve ratio. Losses from past bank failures and reserves related to potential future bank failures affect the reserve ratio by lowering the DIF balance. 2 banks failed in March 2023, following more than 2 years without a bank failure. The failures of Silicon Valley Bank and Signature Bank in March 2023 were estimated to cost the DIF $22.5 billion. Of that total cost, the FDIC estimated that approximately $3.2 billion was attributable to the cost of covering insured deposits and will directly affect the DIF balance, while the losses associated with uninsured deposits will not affect the fund balance or reserve ratio. Importantly, these are estimates and are likely to change over time. By statute, the FDIC is required to recover any losses to the DIF incurred as a result of actions taken pursuant to a determination of systemic risk through special assessments. The FDIC will implement such special assessments to cover the remaining $19.2 billion of losses associated with the support of uninsured depositors through notice and comment rulemaking. Staff plan to recommend adoption of a proposed rule in May 2023. By itself, the $3.2 billion estimated loss from the March bank failures will not have a material effect on the projected timeline for reaching the statutory minimum reserve ratio. In recent years, and until the March bank failures occurred, the DIF had experienced historically low losses from bank failures, and the contingent loss reserve for anticipated failures had fallen to $31 million as of December 31st, 2022. In the wake of the recent failures and heightened uncertainty, however, reserves related to potential future failures may increase. As additional data becomes available, staff will incorporate this information into its projections for the reserve ratio and will update the board accordingly. While banking metrics remain sound, uncertainty has increased and significant downside risks have emerged. Future economic and banking conditions remain uncertain due to the effects of inflation and higher market interest rates, and exacerbated by the volatility in the banking industry as a consequence of the failures of Silicon Valley Bank and Signature Bank. These downside risks could present challenges and have longer-term effects on the condition and performance of the economy and the banking industry. Insured deposits increased by 1.5% in the second half of 2022, resulting in annual insured deposit growth of 3.3%. While below the long-term historical average of 4.5%, the 2022 annual growth rate was still meaningful since it was applied to a total balance of insured deposits that remains elevated from the pandemic response efforts. The outlook for insured deposit growth remains uncertain and depends on several factors, including the outlook for inflation, interest rates, and depositor behavior. Depositor behavior in light of the recent bank failures could also affect deposit trends. However, the magnitude and duration of that response at the time of this update remains uncertain. Staff will continue to closely monitor these trends. As of December 31st, 2022, the DIF balance totaled $128.2 billion, up $5.1 billion from 1 year earlier. Assessment revenue continued to be the primary contributor to growth in the DIF balance in the second half of 2022, even though assessments earned do not yet reflect the 2 basis point increase in assessment rate schedules, which took effect on January 1, 2023. The weighted average assessment rate was 4.0 basis points for the period ending December 31st, 2022, roughly equal to the weighted average assessment rate at the time the restoration plan was first established. Growth in the DIF balance has been limited by a prolonged period of low interest rates coupled with elevated unrealized losses resulting from a rising interest rate environment. However, this headwind abated in the fourth quarter of 2022. For the second half of 2022, net investment contributions, which includes both interest income and unrealized gains or losses, totaled $227 million compared to negative $1.8 billion in the first half of 2022. While subject to changing market expectations of future interest rates and potential use of DIF liquidity related to bank failures, staff expect that in the near term, the DIF will earn modest interest income that may be offset or supplemented by unrealized gains or losses. Based on available data and supported by the recently finalized increase in assessment rate schedules, staff project that the reserve ratio will reach the statutory minimum of 1.35% ahead of the statutory deadline. While subject to uncertainty, staff project that it is possible the reserve ratio could reach 1.35% as early as 2024 under favorable conditions, including stable interest rates, low losses from bank failures, including the recent bank failures, and a continued moderation in insured deposit growth. However, it is also possible that the reserve ratio could remain below 1.35% for several additional years, given the uncertainty surrounding the losses to the DIF for the recent bank failures and reserves for potential future bank failures. As additional data becomes available, staff will incorporate this updated information into its projections for the reserve ratio and will update the board accordingly. In either case, given the increase in assessment rate schedules, effective January 1st, 2023, staff project that the reserve ratio will reach 1.35% by the statutory deadline of September 30th, 2028. Thank you for your time, and we are happy to answer any questions that you may have.
Ashley, thank you very much. That was very helpful. I have a brief statement, and then I'll turn to the other members of the board for questions or comment. The Federal Deposit Insurance Act requires the FDIC's Board of Directors to adopt a restoration plan when the reserve ratio of the deposit insurance fund falls below the statutory minimum of 1.35%. The reserve ratio of the fund is the ratio of the fund balance to all insured deposits. Extraordinary growth in insured deposits during the first half of 2020, resulting from the response to the COVID-19 pandemic, caused the DIF reserve ratio to decline below the statutory minimum of 1.35% as of June 30th, 2020. On September 15th, 2020, the FDIC Board adopted a restoration plan to restore the DIF to at least 1.35% within 8 years, as required by law, and to maintain the assessment rate schedules in place at that time. On June 21st, 2022, based on projections that the reserve ratio was at risk of not reaching the statutory minimum of 1.35% by September 30th, 2028, because of continued insured deposit growth, the FDIC Board amended the restoration plan. The Board proposed and subsequently finalized in October an increase in initial base deposit insurance assessment rate schedules of 2 basis points to improve the likelihood that the reserve ratio would be restored to at least 1.35% by September 30th, 2028. The revised assessment rate schedules became effective January 1, 2023, and are applicable to the first quarterly assessment period of 2023. This increase in assessment rates was intended to strengthen the DIF as the banking industry was facing significant downside risks, including inflation, rising interest rates, and slowing economic growth. The amended restoration plan requires the FDIC to update its analysis and projections for the DIF balance and the reserve ratio at least semi-annually, and if necessary, to recommend modifications to the amended restoration plan. This is the first semi-annual update of 2023 that was presented today. The bottom line to today's update is that even with increased uncertainty in the banking industry and the recent failure of 2 large banks, staff project that the losses from the 2 failures are not expected to have a material effect on the projected timeline for reaching the statutory minimum reserve ratio of 1.35%. The reserve ratio is expected to reach the minimum ahead of the statutory deadline of September 30th, 2028, and staff recommend no changes to the amended restoration plan at this time. The failures of Silicon Valley Bank on March 10th and Signature Bank on March 12th were due to sudden and unexpected liquidity needs as a result of large withdrawals of uninsured deposits. The FDIC estimated the cost to the DIF for these failures to be $20 billion and $2.5 billion, respectively. Of that total estimated cost of $22.5 billion, the FDIC estimated that about $19.2 billion was attributable to the cost of covering uninsured deposits pursuant to systemic risk determinations made on March 12th. By statute, the FDIC is required to recover through special assessments the estimated $19.2 billion of losses to the DIF incurred as a result of the FDIC's actions pursuant to determinations of systemic risk. The FDIC will do so through notice and comment rulemaking in May. As a result, the $19.2 billion in losses to support uninsured deposits will not directly impact the DIF balance because the FDIC is required to collect a special assessment for those losses. The remaining estimated loss from these 2 failures of $3.2 billion will directly impact the DIF balance. However, this estimated loss alone is not expected to have a material effect on the projected timeline for reaching the statutory minimum reserve ratio. FDIC staff will continue to update the board semi-annually or more frequently as conditions warrant to determine if changes to the amended restoration plan are necessary. Reaching the statutory minimum reasonably promptly and in advance of the statutory deadline strengthens the DIF so that it can better withstand unexpected losses and reduce the likelihood of procyclical assessments. Finally, I would like to thank the FDIC staff for their thoughtful work on providing this restoration plan semi-annual update. That concludes my statement, and I'll turn to Vice Chairman Hill.
Thank you, Mr. Chairman. I'll be fairly brief. I support the principle of building up the deposit insurance fund during good times to avoid the potential need of pro-cyclical assessment increases during bad times. I also recognize that building up the DIF is not free and that funds taken from the industry to fund the DIF are funds that would otherwise either be put to productive use in the economy or bolster the resiliency of individual institutions. I understand there are going to be several occasions in which the board will be considering issues related to the DIF and DIF management at upcoming board meetings. For example, it sounds like we will all be back here next month to talk about the special assessment. I want to thank the staff for the update, and thank you, Mr. Chairman.
Thank you. Director McKiernan? Director Sue? Director Chopra?
Well, thank you, Ashley and team, and also wanted to recognize the first open board meeting of 2 new board members today, and it's good to have a full complement. Let me just ask a couple questions. One is, I think there's been lots of third-party projections, our own projections about the arc of deposit growth or decline. And I think some third parties actually suggested that there would be a decline in the fourth quarter of 2022, and we saw an increase again. I just wonder if there's obviously some differences in the post-COVID world. I wonder if you could share a little bit more about how the board should think about the pace of growth in the insured deposits going forward.
Sure. Thank you, Director Chopra. So, yeah, in fact, throughout 2022, insured deposits and uninsured have actually, they're often correlated to growth, and in this case, they acted very differently. Insured deposits grew at, as Ashley noted, 3.3% throughout the year, including growth in fourth quarter. They grew 3 out of the 4 quarters, so the 3.3% is slightly below historical. And again, I think that's something we expected. With uninsured, they actually declined all 4 quarters throughout 2022 and actually declined at a fairly significant pace. So they've acted differently. I think I'm a little reluctant to even talk about 2023 given the recent failures. I think there's likely to be significant changes in behavior as we've seen using H8 data of some deposit outflows. And what's unclear is how that might happen in between insured and uninsured. But I think there's some expectation that you'll see some shifting further into insured, and that there's been some use of technology to try and expand deposit insurance. So I think we're all very interested to see what the first quarter numbers look like. But I would say that the world of higher interest rates have clearly affected and changed depositor behavior, and will continue to do so, I think, and it's something I think we'll observe. But again, I think that insured have tended to be stable throughout 2022, and I think we'd expect some continuation of that, if not movement into it. And then uninsured sometimes are pursuing higher rates.
And is there anything you want to comment about? Obviously, we have seen a significant migration from bank deposits to money market funds, other instruments. Are there moments of the past that you think might give us more texture on how we might make future projections?
Yeah, as it's always, unfortunately, I don't know that this has a direct comparable, this event and this behavior. So one of the things that's relatively, when I say relatively new within the last 10 years is the access for money market funds to use the reverse repo facility. And so that also affects deposit flows to a certain extent. So I think that's something we're gonna have to continue to observe and understand better. So I think that is something that's new relative to other times of increasing rate environments.
Well, I ask these because I think we as a board should be clear-eyed that it is going to be very difficult to predict the pace of where the insured deposit base is. Obviously, there are moments like COVID which present a different type of dynamic, but even going forward as well. So I think part of the reason I mentioned that uncertainty is that, you know, what the vice chairman has said about favoring a counter-cyclical type approach in building up the fund. I've shared this with you all before. I do think it is something over the long term we need to build in. And, you know, there were, you know, some years where banking industry profits may have been robust, but we didn't necessarily get, you know, real increases in the reserve ratio. And there are times when the economy is contracting and we don't want to be, you know, adding to injury. So I think part of this is some long-term thinking about what do we do. My own view is that it's not just counter-cyclicality, but there's more we can do when it comes to making sure the premiums are risk-based. I think our own experience and the data suggests that for the vast majority of institutions, particularly small ones, they're easy to resolve and therefore do not pose much cost to the fund. And where we have had as losses to the fund over the years has been from larger institutions. And I think that is a place where we need to continue to pressure test whether the way we are doing assessments is adequately pricing risk. I think if we do look at that new framework, we would obviously want it to be in some ways neutral. And I predict that if we do that in a rigorous way, some of the larger institutions who do pose more risk to the fund will pay more, and certain smaller ones will pay less. So I hope that you continue to think about that as we chart forward, not just the restoration plan, but also really the long term of, I totally agree with what Vice Chairman Hill has said on the countercyclicality point. Let me just comment a little bit on what the chairman has said about the special assessment. I'm very glad the board is starting to think about, and that the chairman has highlighted, the statutory provision around the special assessment, which allows us to look, in some ways, I'm paraphrasing, at the institutions who benefited from the invocation of a systemic risk exception. I think it's clear there are a set of institutions who benefited more than others, and I think we should make sure we fairly allocate those. So I'm really looking forward to us really doing all the appropriate analysis and proposing it in the coming months. So I'm glad we're making, I'm glad we're on track to beat the statutory deadline, but obviously there is still great uncertainties about how deposits, what the deposit base will look like, as well as the interest rate environment. So, you know, we'll all be sure to support you in making sure we land in a good place. That's all I have.
Thank you. Thank you, Rohit. Any further comment or questions from the board? If none, may I have a motion to accept the DIF Restoration Plan semi-annual update? Motion. Thank you. And a second? Thank you very much. All in favor, please say aye.
Aye.
The motion is adopted. Is there any new business? If none, this open meeting is adjourned. We'll move into closed session. And thank you to the staff for the very helpful presentation.